This is a difficult time to be an investor. Even with all the pain that we've seen throughout the first 3 quarters of the year, as we head into the fourth quarter, there's still a lot of uncertainty that is facing the markets. Among many other things, we have the Fed that's increasing interest rates at the fastest clip that we've seen at really any other time in modern history. At the same time, they're reducing the size of their balance sheet, pulling liquidity out of the markets. And when we look at that uncertainty in light of where short-term interest rates are and how much higher they are than they were at the start of the year, we have seen a lot of investors that have either been trimming or selling out of their equity positions altogether and moving into cash. And while short-term interest rates are certainly more attractive than they have been in some time, we really believe right now it is so important to cautiously maintain our exposure to the equity market for several different reasons. First, even if you look at where interest rates are at today, call it 4% on a 1 or 2 year treasury, at 4%, it's still going to be very difficult to generate a positive real return given where inflation is at. Secondly, and more importantly though, market timing is difficult, if not impossible, and has been such a costly mistake for so many different investors over the years. So being in the market, we believe, is really important. And just to point to an example of this historically, if you think back to the last time inflation was this high, back in the early 1970s and early 1980s, there was a lot of uncertainty that was facing the market at that time as well. You had a Fed that was very aggressive, inflation that was very high. You had the Volcker shock, 3 different and distinct recessions that played out in that decade-plus span. But in light of all those headwinds, if you look at from the beginning of 1972, when inflation started to take off, through the end of 1982, when you started to see that issue resolve, the total return that the S&P 500 delivered was right around 128%. That's almost 8% year over year. So was there volatility along the way? Yes. Were there larger drawdowns along the way? Yes. But if you were an investor and you held throughout that entire time period, were you probably happy? Yes. So right now, we continue to believe, despite all the uncertainty, all the headwinds, making sure that we cautiously maintain our equity exposure is of utmost importance.